Strand Global Macro is a student investment fund based out of King's College London. We primarily focus on long equities with an overarching macro perspective. Strand Global Macro Talks is the podcast arm of the student investment fund, where our goal is to interview chief investment officers and portfolio managers to understand their investment strategy, psychology, and philosophy, to give students a better understanding of the investment management industry. If you guys like this podcast, make sure to like and subscribe and keep the notifications on for a new episode will be posted once every 2 weeks. Hope you enjoy this episode. So hi guys, welcome to episode 2 of the Strand Global Macro Talks. Today we've got Marcus, CIO of Umbra Capital. Marcus, thank you for joining us.
Pleasure.
For listeners that may be less familiar with Umbra Capital, how would you describe the investment strategy? And in simple terms, what type of opportunities are you guys trying to capture?
Of course. First of all, thank you for inviting me onto your podcast. It's a pleasure to be here. So Umbra Capital Partners, we're a London-based, privately owned, established boutique firm. We have a very broad area of expertise centered around private markets, debt, equity financing for SMEs here in Europe. So we've historically backed very successfully a number of early stage businesses across a large swathe of various different sectors. We tend to favor more defensive orientated sectors, sectors where we feel as though there's dominant secular trends with growth behind those sectors, whether it be in healthcare or technology. So we've financed a number of those businesses during our life cycle, really, since were founded 7 or 8 years ago. Separately to that area of the business, we also have a discretionary investment management arm. I head that up essentially as CIO. I've been with the firm now for 4 years. Previously, I started my investment career in 1999. So I got 27 years now in industry experience. I've been on the buy side throughout, working for a number of well-established investment management houses. I started originally at Phillips & Drew, a UK blue chip buy side equity outfit, now owned by UBS. Back in 1999, I saw the very last stages of the tech bubble before its ultimate bust in 2000, and that really shaped my way of thinking and understanding in investment management and what can theoretically go wrong and right, I guess, very early on. And then after that, I went to work for a multi-strategy hedge fund in London, who are still in existence today, Head Start Advisors. I was there for 3 years, and then I was approached by Stonehage Fleming, who are today one of the largest multifamily offices in the world. I was there for 4 years before the division I was working within at Stonehage was ultimately merged just after Lehman Brothers went bust, actually, in the Great Financial Crisis in late 2008, with another business called ACP Partners, and that entity became ACPI Investment Management here in London. I was there for 10 years. I was partner. I was senior fund manager as well. And then that business in 2019 was bought by Union Bancaire Privée in Switzerland. I was there for 3 years, and then I joined Umbra. And I think Umbra today, what really I think differentiates us a little bit, and in terms of what we do, aside from our private markets and investment management offering, is I'm surrounded by investment professionals who are very experienced in their field of expertise. So, all the professionals and the staff, the founders of the business they've got a background similar to my own, having worked at Morgan Stanley, Credit Suisse, UBS historically. And I guess just really love doing what they do, but without, some of the bureaucracy that can at times, be evident within some of the larger organizations, the bureaucracy, the red tape to a degree. That's essentially what we do today on the behalf of clients that really cover, various different audiences and types, whether it be from established pension funds from all around the world through to high net worth, ultra high net worth clients, as well as retail investors as well. So, we have a number of different offerings that cater to those different end audiences essentially.
And so for your discretionary management arm, what type of strategy do you guys primarily focus on? I know you have multiple fund managers, but what is essentially kind of the focus of the strategy?
Yeah, so that's really client led. We really have an offering that is completely open architecture in nature, depending on the end client. We obviously assess each independent client's long-term return objectives, their tolerance for volatility, their liquidity parameters, um, their longer-term ambitions, and then we skew and tailor. We can tailor offerings and portfolio solutions to tick, to fit into that box essentially. So we have standardized risk models, and we also have bespoke offerings as well. Now, because our backgrounds really cover everything across liquid and illiquid markets, we can obviously bring those understandings into that ultimate offering. My hedge fund background serves, I think, our clients well from understanding both illiquid as well as liquid alternatives, and the role that they can play within a broader portfolio from a diversification, another attribute to returns, as well as our long only expertise, whether that be within equities through direct solutions, as well as external active funds and ETFs, and bond exposure as well. And I guess what we essentially have from an overall perspective is, from an instrument perspective, is as cycles fluctuate, we essentially have, hopefully, all the different levers to pull on the behalf of our clients to capitalize from the best risk reward opportunities as markets gyrate. And I think that's the key, to delivering, hopefully, a good outcome for clients. So our risk models, the standardized risk models, we have a model portfolio service, so an MPS here in the UK that we established, 3.5 years, nearly 4 years ago now. That is established with ARC, a very well-established rating agency that sits on a number of UK established platforms, as well as actually having a subsidiary that suits that offering. But we can tweak and take those portfolios or those models on the behalf of that different end audience, basically, depending on those objectives, as I originally alluded to. We also have a UCITS fund established in Ireland. That's a global balanced fund, as well as really for the bulk of what we do, which is basically bespoke portfolios for high net worth ultra net worth clients. We then have a range of different client portfolios that, to some degrees, have a degree of overlap with our MPS portfolios. I mean, within our MPS portfolios, we have 7 risk models from defensive all the way up to equity. So defensive, cautious, moderate, balanced, growth, adventurous, equity. They're different from a volatility. So, the risk rating agencies basically look at volatility, and then they badge each of those models depending on volatility, which is obviously backward looking. And then we have those 7 risk models available in 4 different cost structures. So 28 models in total, 4 times 7. We then have 3 income orientated MPS models that are defensive, cautious, and moderate. When we launched those, 3 years ago, just given the recalibration and the revaluation pullback that we'd seen within bond markets, we didn't really feel as though we had to go out along the risk curve to derive, I guess, or extract a more attractive level of income. So those portfolios have done well, particularly over the last couple of years, as inflation has continued to moderate, barring what we've seen over the last month with Iran. And then obviously accommodative central bank policy and monetary policy more broadly has obviously underpinned bonds to a degree as well. And then we have 3 building block portfolios that are very different to our MPS offering. So we have building blocks are basically consist of 4 or 5 different underlying multi-asset funds that, theoretically can oscillate across the cycle stylistically as well as regionally themselves. So we lead the asset allocation decision and bottom-up stock selection process, at the discretion of the ultimate external managers. So, this orientation tends to be with very well established fund managers, whether it be here in London, the likes of Troy, Latitude, you've got Vanguard, as well as 1 or 2 additional aspects around them that bring their own degrees of expertise within that. So we have a multi-asset balanced portfolio and an adventurous portfolio, and then we also have one absolute return portfolio that in theory should be able to generate positive returns in all environments. So within that toolkit, we're essentially bringing liquid alternatives such as systematic trend following strategies. So we have allocations to Aspect, a very well established London-based systematic manager here in London that launched back in the late 1990s. And we also own the Argonaut equity long short program, managed by Barry Norris, again here in London as well. So both of those liquid alternatives, and in my view, they are genuine hedge fund strategies, have zero correlation to the MSCI world. And that's really what we're looking for, really, when we think about hedge fund orientation, decorrelative returns really to our residual long only equity or credit beta that, obviously populates the broader portfolios.
Yeah, I mean, it sounds like you have a lot of strategies. I mean, when we're looking at an environment right now where we're kind of in a risk-off situation, where we have this Iran conflict going on, we have poor macroeconomic outlooks, especially in the US, although, jobless claims came very good this morning. What is the most important thing that you guide yourself on all of these portfolios? Are you looking specifically at macro factors? Are you looking at valuation or event driven? What's kind of the thing that's guiding you at this moment?
Yeah, I think we're long-term investors, and I think that's really key. You know, to get end solutions and good positive outcomes for end clients, I think you need to be a long-term investor, and a big believer in the compounding of returns over the long term, and hopefully letting compounding returns really drive good cumulative returns over the long term. Now, how we go about thinking about that from a broader asset allocation sense is obviously, there's a couple of different factors that we do certainly bring into our internal asset allocation decision making. So again, that's all internally driven. We're not really dependent on any external party to really drive that. Valuation is really key. I'm a big believer in what you pay for a security often dictates your forward rate of return. I think there's a price for everything in the market. Don't get too wed to any particular style, i.e. value versus growth. There are certain periods within the macro context where certain styles of investing will work and others will be heavily out of favor. I mean, since the COVID lows, we've been actually in a very value-orientated bull market. Growth has obviously been in a relative bear market since that low in 2021. And that's obvious. The primary reason why value has done so well and growth hasn't is because bond yields have normalized and yield curves have normalized, and with pretty chronic budget deficits that still continue to be run within Western G7 markets today. Bond yields are high because inflation has been a little bit stickier and a little bit more problematic, but governments continue to really continue negative budget balances, so budget deficits. So that's meant that yield curves have normalized to a degree. Now, obviously, what that's meant for growth strategies and growth equities more broadly is obviously bond yields obviously serve as a discount rate or a discount mechanism for long duration cash flows. So what worked prior to when quantitative easing was taking place prior to COVID, really from after the financial crisis and the Eurozone crisis of 2011, all around the world, central banks were pretty aggressive in putting pretty substantial quantitative easing measures into their economies to try and drive and underpin growth. So bond yields went to zero, arguably. Certainly they did, post-COVID, immediately post-COVID. And that underpinned growth as a style. So I think, understanding that was quite key from a stylistic starting point. So valuation is key, I think, overall. And it's very easy to say, but you want to, Warren Buffett obviously says it, you want to be greedy when others are fearful and fearful when others are greedy. And valuation, I think, correlates to that. So when valuations are very high, arguably a very rosy outlook is already embedded within that starting valuation. And whether it be within equities, you need earnings growth to really come through to warrant the high multiple that you may be paying today. And the inverse is true. When valuations are very low, PE multiples are very low, or free cash flow yields are very, very high, then arguably there's already a certain degree of pessimism already baked into the price. So valuation is key, and that's also true for bond yields as well. What's on offer across large swathes of the bond market that we look at from a starting yield to maturity perspective. We'll look at real yields encouragingly as well, so we're not too worried about absolute yields. So that really frames our thinking in terms of how we will oscillate. And then there are other factors as well. Liquidity, when liquidity is ample, it often drives risk assets in general. Equities tend to do very well when you see a turn in the liquidity cycle. So how do we do that? We'll look at the dollar cycle. We'll look at central banks' balance sheets on an aggregated basis. We'll look at implied levels of where monetary policy expected to be globally today, but also on a forward-looking basis as well. And when the dollar is often weak, you tend to see large swathes of the global equity market do well as well. So Asia tends to do well, emerging markets tend to do well, which is all very obvious because a lot of those economies are pegged to the US interest rate cycle. So when the dollar is cheap, that tends to be a good stimulative force behind those domestic economies within those regions. The companies tend to borrow in dollars at cheaper levels, and their domestic currencies often rise on the back of that domestic growth that they're seeing. So I think the understanding of where we are in the dollar cycle is quite key as well. And again, we'll look at valuations on the US dollar. We'll look at that from a real effective exchange rate basis level. We'll look at it on a PPP basis as well. So yeah, that's one of the key factors. And then from a sentiment perspective, we'll also look at sentiment. We get good insights on, hedge fund positioning across various different prime brokers. We also look at retail investor surveys, whether it be the AAII survey in the US or the fund manager survey that's provided by Bank of America Merrill Lynch. We'll look at technical factors, just looking at how overextended or indeed how oversold some markets can be. And I guess it's a qualitative aspect, about understanding all those different variables to understanding, potentially good entry points or indeed whether to take off some risk within exposures. I think above all, probably understanding those is quite important for when you're taking cyclical exposure as well. A big believer in, it's really about containing the downside, basically. So again, I think you want to be buying cyclical exposure when those valuations are in your favor. Hopefully you're buying cyclical exposure at depressed multiples and depressed profitability, so it's good to see margins at lows. It's often a good time to be embracing cyclicality and taking that off when you see the inverse. So if you're in a cyclical sector or company or even region, and you're paying very high multiples for that exposure predicated off high margins as well, then your forward rate of return tends to be quite poor. And there's been good examples where historically we have timed entry into those markets at low levels. I think politics also today is quite crucial, and plays its part, and certainly in what it means for risk assets in general. I mean, you can look at so many different factors today here in the UK, for instance. And the pretty poor economic trend that we're in today for a whole host of, I think, political reasons. And that can also follow through into the US as well. And what President Trump's second term in office has meant for things like the US dollar and tariffs to a degree, as well as some of the reshoring and remanufacturing that is now taking place back into the US, which has obviously been good for a whole host of different countries that have really built out, or arguably are going to build out, their presence in the US as well. So a lot of various different factors that are brought into the overall mix there.
So I'd like to follow up with my questions now. You sort of mentioned how clients have their sort of own returns, expectations, and tolerance for volatility. So I wanted to ask you if understanding of their own risk tolerance, is it something that clients usually have a good understanding of, or do you sort of have to help them figure out?
Yeah, I think it's a learning curve, and it's an ongoing level of communication, and it's a relationship that is driven hopefully over a series of years. I think risk is, in my own view, often misjudged or misguided. I mean, the risk, in my view, is actually not meeting your longer term return objectives relative to what risk may be defined by, if you were to look at something as simplistic as a volatility gauge or standard deviation gauge. So the way things work right now in large swathes of the industry is risk is defined by volatility. So arguably, if you're a low risk investor and you're having a substantial part of your overall pension fund pot or your personal account within a low risk security or area of the market, just to tick your low risk volatility box, then the risk quite clearly over the longer term comes through potentially not actually meeting your return objectives. So I think it's about, for clients, understanding that and actually embracing a little bit more risk, i.e. equity exposure, hopefully at the right price valuation when markets are heavily discounted, and arguably valuations are more geared towards you and in your favor to hopefully meet your longer term return objectives relative to the volatility that you're going to experience. And I think volatility, it's no bad thing. It's something that should be embraced, because when markets are heavily discounted, then that is often the best time to be a little bit more gung-ho and more pragmatically thinking about taking risk. When there's blood on the streets, arguably, you want to be in the market. When everything is euphoric, valuations are very high, everybody's in the market, you're in your taxi and the taxi driver is telling you to buy certain things, that is often the bad time to be in the market. You probably want to be a little bit more cautious. So there's a degree of contrarianism within that. So, be the contrarian to a degree, and I think objectively look at these variables.
So in terms of like more on portfolio level risk, so I would guess that most risk averse investors would be sort of more concerned about losing their money rather than superior gains. So does that make the measure like the Sortino ratio a more relevant measure of portfolio risk than the Sharpe ratio?
Yes, to a degree, but remember, all these ratios and a lot of the quant factors, they're always backward looking. You're kind of reacting to something that is in the rear view mirror. And I think if you're making portfolio decisions based on something that has happened historically, it's often, the forward returns or the forwards, the forward outcome based on that adjustment that you've made based on that data is not often always great. You know, how we try and preserve capital is again through valuation, you know, and having that fixation on the starting valuation that you pay. Something that you pay often dictates your forward rate of return. And it's about gauging what can theoretically go wrong in asset allocation or security selection and can what theoretically go right. You know, and you can look at that from a number of different perspectives, but I think the starting valuation point is quite key. You know, I mean, I can go into a couple of examples on how we frame that, but that's quite key. On the equity side, you know, we do tend to have some certain quality factors within our tilts at time, whether it be from a security perspective or indeed through the types of active funds that we tend to allocate to. So as I said, we're pragmatic allocators of capital across external funds, particularly on the active side. We'll tend to be invested in funds that can pragmatically oscillate across their markets in which they're investing. But we do tend to have a quality bias within that. What do I mean by that is, you know, they tend to have exposure to companies that have great balance sheets. You know, if they're taking cyclical risk, it's towards companies that arguably have underlying good balance sheet quality. They also tend to have good margins. You know, hopefully companies that during tough periods can still, you know, hopefully drive profitability through the margins that they have. And if you're taking cyclical risk, you know, you probably want to be exposed to those companies that, you know, aren't inevitably going to go bust, or if margins are, you know, somewhat variable, then arguably you're buying that cyclical exposure at low profitability today. But again, that comes back to, you know, the starting valuation parameters that I think are quite crucial as well.
So you mentioned multiple times about, you know, long-term returns and investing in long-term positions. But when markets are in periods of fears, such as right now, and what makes you or allows you to separate all the noise from all the news and to what really matters and what can possibly create a long-term shift for your long-term thesis and investments? How do you separate that from all of the noise we're seeing in this current fear factor market?
Yeah, I think you've got to remember that, you know, equity markets they're a discount mechanism. You know, they tend to look through much earlier on. Arguably the shifts that we may see at a macro level, you know, within economies to a degree. I think it's quite crucial not to get too caught up in the news flow. As I said, you know, for us, a lot of it depends on the starting valuation. We actually did within portfolios take off some risk in February. I mean, markets had done very, very well going up to February. You know, 2025 had been a very strong year for risk in general. And we'd seen valuations creep up, back up to pretty, you know, high teen multiples in the vast majority of regional equity indices through last year. The dollar had been very weak as well. And, you know, the year started very strongly. I think what was becoming very consensual trades or opinions within markets, and to a degree, you know, there wasn't too much negativity arguably priced in. We'd seen the military buildup that was really evident across the Middle East by the US over the months of January and February. And we use that really as a time to, you know, take some risk off the table away from some of those arguably what become very consensual trades within the market. So we'd reduce some of our, for instance, some of our emerging market debt, local currency exposure. Again, you know, that had done very well on the back of the outlook for the US interest rate cycle and the, you know, the general weakness in the dollar overall. We also took back some of our exposure in emerging market equities as well as Asia. We cut our exposure to European banks. Again, European banks had done very well last year for a whole host of different reasons. The yield curve has obviously been beneficial for banks in general. the substantial fiscal package, arguably going to be unveiled across Europe this year, had already been baked into the price again for some of the more cyclical orientated ends of the equity market. But we'd seen from a valuation context was a pretty significant re-rating. So European banks, back in February, only a month or so ago, were back up to around 1.5 times book value, predicated on an ROE of around 12, 13, 14%. So again, cyclical highs. And we took risk off there as a result of that. Now, obviously, with Iran and the potential knock-on impact to growth that this inflationary shock is potentially going to have on Europe, to a degree, leaves something like European banks arguably vulnerable, because obviously they are correlated to a degree to the economic cycle. So that was our original thinking and thesis as to why we did take some exposure off. But during the month of March, I mean, the pullback that we saw was obviously incredibly violent. Again, I think it was reflective of just the crowding that was evident within some of those areas. We look at some of the peripheral markets or markets, I guess, that had done very well on some of those consensual trades, areas such as South Korea. The Kospi index had a fantastic 2025. Also started this year very well for a variety of different reasons. The whole shareholder reform was really starting to come through in terms of corporate governance and shareholder return. A lot of companies trading below book value, and obviously, companies that were being driven by management teams that were arguably giving more cash back to shareholders, increasing dividends and share buybacks as a result of that. And of course, South Korea has been a big beneficiary as well from two additional tailwinds really over the last year or so. So the weaker dollar, obviously South Korea, big export-driven market, as well as the what appears to be the insatiable demand for semiconductors, as a result of the AI build out. So anybody looking at the earnings trajectory of something like Samsung or SK Hynix, you can see that feed through into that index, but it would become obviously very consensual. So, again, that was something that we were looking at during the pullback in March. We saw around a 24% pullback. The market had got down to around 7 times earnings, which again, I know that's very cyclical and driven by what you're seeing by SK Hynix and Samsung today. But again, we had some risk within some of the Pan Asia ETF, and as well as 1 or 2 active funds that we have exposure to arguably, hopefully take advantage of that. And obviously over the last couple of weeks, we have seen a pretty decent rebound within what was quite clearly a heavily oversold and a heavily, arguably over discounted area of the market.
Yeah, so you talk about de-risking your portfolio, taking over some of those gains earlier this year. What happened is then we had the huge Iran war crisis. Markets fell significantly from those higher January highs. And now, due to the ceasefire and more so hopeful reopening of the Strait of Hormuz, we've seen them jump up quite a lot. But, in this very concentrated Max 7 S&P 500, some of these gains are not whole broad market gains, but more so we've seen for the last 2 weeks that AI demand has been surging. We're seeing announcements with Meta, Anthropic, Broadcom, Amazon every week, and that's kind of pushed the market maybe higher than what investors may think. So if you're seeing a market that's maybe had a fake rebound, now would you consider de-risking? And again, you said military buildup earlier this year. You guys saw that as a key indicator. We saw the Wall Street Journal this week say that the Pentagon is sending more troops, and they're sending a lot of troops into the Middle East as we speak. And there's another aircraft carrier that's currently going towards the Middle East. How would you kind of gauge the situation, and would you think now is a good time of de-risking?
Yeah, that's really difficult, I think, to take a call on, because at the end of the day, you're dealing with Donald Trump. His policy is tweeted, and it's pretty evident that he can change his mind on a dime, day after day. So I think, again, detaching from the news flow is quite crucial, and having that fixation on valuation. Now, for the US and the Mag 7, I mean, the risk-off period that we saw in March, with that risk-off period, the dollar was strong. So naturally, US equity markets tend to do relatively well when the dollar is strong. So again, there's a perceived flight to safety there. So dollar being strong, if you have dollar exposure and you're running an equity mandate, you have to really own an area of the US equity market. Now, for a lot of tech businesses in the US, and we saw this during COVID, when COVID emerged and started, a lot of these very dominant Mag 7 stocks did very well during COVID for obvious reasons. I mean, people were still working. They were working from home on their laptops or computers more broadly. And today, that's still true. So, a lot of the profitability in these businesses is still there. Yes, they're spending a lot on the AI build out. Whether that is through their own decision making or not remains to be seen. But the risk is that they don't do what their competitors are doing, and obviously, if this proves to be profitable for them, that's the million-dollar question right now. This colossal amount of money that is being spent globally. I think there's $5 trillion now being committed to AI build out globally. Crucially for equity investors in the businesses is, can these companies generate an attractive return on investment relative to the capital that they're committing today? Now, fortunately for a lot of these businesses, they're driving that increase in capex either through cash on their balance sheets or the generation of free cash flow that a lot of these companies generate. I mean, they were low capital intensity. They're shifting to more capital intensity going forward because of the need of these data centers and embracement of AI more broadly. But the valuation reset, again, that we've seen in that area of the market, I think at the low prior to the rebound that we've seen of late, the Nasdaq had pulled back to around, or the tech sector in the US more broadly was back on low 20 times multiples on a next 12 months basis. So again, that was the similar kind of trough that we saw during the Liberation Day sell-off in Q1 of last year. We had a little bit more during COVID, obviously, but again, with the secular growth story around tech, yes, there's going to be winners and losers from AI. We don't get too smart on picking those winners and losers. Yes, there are good active funds out there, but I think having a sensible allocation to an ETF, for an example, makes sense because of the secular tailwinds behind tech. And tech has been in a secular growth market because everybody's businesses more broadly are embracing tech now, and it moves all through all these different cycles from consumables all the way through to businesses as well. But it's about understanding, I think, again, the valuation. There is frothiness within some areas of tech. There's a lot of tech businesses in the US that are unprofitable. Hopefully a manager can pick out the winners or the losers and have that discretion on that ever evolving sector, but it's just not something I don't think you can ignore because of that secular growth dynamic behind it.
Yeah, thank you. So finally, I'd like to sort of close up with a question on some advice you may have for students. So you started your career in equity research on the buy side. So for sort of students like me who wants to sort of start a career from equity research, what would you say sort of that kind of background gives you that's hard to get elsewhere?
Yeah, I think that the industry has obviously changed so much and continues to change. I mean, that's, I think, one of the things that entices me to this industry. Every single day is different, not only from an industry change perspective, but also from a market change perspective. And I think adapting, I think financial markets they're like an ever evolving jigsaw. And it's about understanding potentially where the pieces fit as the cycle obviously evolves, and hopefully that keeps people engaged to a degree. I think technology embracement and really understanding how the changes in technology are obviously shifting within the industry. From an equity research perspective, the industry today again is being challenged. I think from a human headcount perspective. We've just started to trial Anthropic, Claude, and see what Claude can do. Obviously, we aggregate a ton of data on an ongoing basis. A lot of that data is redundant and just out of date as soon as it's published. But we obviously use that data internally to form our own asset allocation decision-making process. We use it within our literature pieces, both internally as well as externally, for our client audiences and prospects. And hopefully Claude, can really help us consolidate a lot of what we digest on a day-on-day basis within that. So I think understanding technology from a graduate perspective is just key. I did my degree in banking and finance, and technology didn't feature really within that degree when I did it. Back in 97 to 2001. So tech is just so important today within financial markets. Not only through using things like Bloomberg and data stream, but understanding inevitably where AI is gonna come in and play its part within this industry, because it will play its part, because it can enhance, it can take out inefficiencies, it can cut costs as well, and hopefully it can lead to better outcomes for clients as well, if so many different angles can be ticked off from that angle. So yes, it's about, I think, understanding the maths and the financial aspects that would be expected within equity analysis, but I think it's also about understanding technology and how that can play its part within that much broader role.
Thank you so much, Marcus, for today. This is the end of the podcast. If you guys liked this podcast, make sure to go see our other ones, which will be posted soon. Thank you so much, Marcus, for joining.
My pleasure. Thank you both. Take care. Bye-bye.